You are listening to Keystone Stock Talk Show, episode 242. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We are back this week after a busy weekend of kissing babies and shaking client hands at the 2024 World Outlook Conference in Vancouver. It was a great turnout and great to see hundreds of clients in the audience. I'm going to kick off the festivities with a snippet of a recent presentation I gave on the powerful impact of adding just one or two great capital compounding stocks can have on your portfolio in your entire lifetime. Aaron will update you on the massive move for Meta Platforms, META, on the NASDAQ, formerly Facebook, which announced plans to implement a dividend last week. Brennan will circle back on Reliq Health Technology, symbol RHT, on the TSX Venture, a telemedicine provider that develops virtual care solutions for the healthcare market. We have fielded a number of questions on the company. And while revenue growth was evident, the lack of profitability made it for a non-starter based on our criteria, and Brennan told listeners to steer clear of this business, with it down another 55% since the last time we reviewed it on the show in the summer of this past year. Brennan answers another viewer question on Reliq. Finally, Brett answers a viewer question on Linamar Corporation, symbol LNR, on the TSX, an advanced manufacturing company for automotive and manufacturing usage. Recent acquisitions have spurred growth, and the valuations are looking intriguing. Brett will give you his thoughts on the company. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn and the Killer Bees, Brett and Brennan.
Welcome.
How you guys doing?
Good. Big weekend.
Yes, I was going to say we're at the
biggest event of the year. Well, I mean, I'd say biggest event, at least for that type of event.
Without a doubt, for in meeting clients, potential new clients for us. We talked to a lot, chatted with a couple management teams. I hosted a lunch. Myself and Aaron presented on Saturday to a crowd of about 900 plus. There's about 1,000 or 2,000 that watch it online. So it's a good event, and we have a great dinner there every year with Michael Campbell. This year, former president or prime minister president. That would be impressive. Gordon Campbell, Victor Adair, Ozzy, and a cast of other individuals were there. So it was good, Kaplan.
Premier.
Yes. Premier?
Premier.
I'm just trying to make him prime minister, right?
Well, you're trying to make him president a minute ago.
Either one. I take him for all three over what's existing right now. How about that?
There you go.
Aaron tried to get him to run again.
I suggested it. I asked his opinion on it. He didn't seem too open, though.
Yeah, I think at this stage he's like, I've done that. All right, we're moving on.
Yeah, you also missed that I rang in the bell with Michael Campbell.
Oh, that was the highlight of the whole weekend.
Huge. Do we have some footage on Brennan up front?
Yeah, this aired today, which is Tuesday morning.
On BNN.
So
ringing the bell for the TSX, opening of the TSX stock exchange, which is
Yeah. So we'll put that up so you guys can see my ugly mug some more.
It'll be great to see Brennan ringing that in with Campbell and.
6, 5, 4, 3, 2, 1.
So you guys found the event well? Did you guys enjoy yourself, Aaron? What do you think?
I loved it. Yeah,
good event.
I thought that my main event speech was great. You did a good opening speech for me.
Opening,
which I thought that everybody
warm up act, right?
Yeah. No, I thought it was really good. I really enjoy speaking there. So it's pretty big crowd. I mean, I don't know what's like 1,000 people or something, maybe more.
Yeah, in that range for sure.
Yeah. 1,000 to 1,500, maybe even.
and more watching it online, which is awesome.
You get the opportunity to see a lot of clients that you've known over the years that you only see at that event. So a lot of familiar faces and, faces that you missed during the pandemic. And it was nice. Last year was the first live event since the pandemic. So that was nice to see some people that I hadn't seen in ages. And you kind of appreciate it more when all the live events get taken away. But now we're back and it's good.
Yeah,
A lot more
good. I mean, there's people
being in front of a crowd of 1,000+ people than speaking in front of my computer screen. And
yeah,
it's a lot more fun. I find, it's more engaging, and it was good. There's people from it's in Vancouver.
That was the highlight of the one of
the Keystone mug.
Yeah,
which we gave out about 20 of them.
My favorite side of the Keystone mug here.
Yes.
Yeah, if you're a client and you got a mug at the event, comment on the comment section below, see if you like it, and
the mug's already out of date too.
I think it's not microwave safe, so
no,
don't melt
That's a problem for me.
It's the cork.
Yeah. It's nice looking though. Yeah,
that's good. No, it was good. There's people. It's in Vancouver, but there's people from all over the country. We had a person at the booth from the Rock out, on the other side of the country, and there's a lot of people from Alberta, Saskatchewan.
Yeah, it was good. I enjoyed talking to people at the booth. I always do. I mean, it's always like nerve-wracking a little bit, to get in public, working from home, of course. But, once you get there, it's just great. I just love shaking hands and talking to people who I've, emailed back and forth with, clients so much, and giving them some, ideas and whatnot. And it's just great to actually, talk to them, see who you're actually talking to via email. And of course, people walking up to the booth and being like, "Killer bees?" to me and Brett. And, yeah, I love it.
You're loving it. And then you stung them, right? Out of nowhere somehow. No. All right. Do you guys want to get to the poll question?
Yeah, let's do it.
Yeah. We had a poll question last week.
That we did. We're starting to put out some more polls on YouTube, so you can just go to the community section if they don't pop up on your front page to vote. But this last one we did is we asked you, our lovely viewers, what do you think the worst performing index of 2024 is going to be? We had going from the highest to lowest. So what do you think is going to be the worst to the best is at the bottom of the barrel, the TSX Venture at 53% of the votes. Then the NASDAQ, surprisingly, at 19%. The TSX Comp at 17 and the S&P 500 at 11.
Yeah, I don't think the bottom one there is that surprising. It's kind of an index that's underperformed historically over time.
There wasn't more people that picked it, to be honest.
Yeah,
and I was surprised so many people picked the NASDAQ.
I voted for it, so
the NASDAQ.
Maybe
no,
contrarian.
Not the NASDAQ, the TSXV being the worst. When it's just like. We're seeing so many companies have like tough comparables off of elevated, inflated commodity prices. So, I mean, that's kind of like
the great thing about most
thought, at least.
TSX venture companies is that they don't really have any financials to compare themselves against the previous years. So
that's true.
It's true. And the thing is, at some points last year, you had good commodity price performance, but the index didn't perform well overall. I mean, the gold price was up significantly, and the index was still down. So I think people are thinking they're being contrarians on the NASDAQ, which had a tremendous year last year, and maybe it comes off a little, but started off with a bang again this year. We'll see where it ends up and see who is right, and it will be Brennan, as always, right, Brennan?
I don't know. My prediction track record's pretty bad, so I don't know if you guys should trust me.
Short, whatever he says. Yeah, that's what we're saying.
Yes.
Fun out of that, maybe.
Yeah.
Well, in the crazy times there, they were making funds of about almost anything, were they not?
Brennan?
So we could have the reverse Brennan index.
Reverse Kramer. Yeah.
Yeah.
Oh, right. The reverse Kramer index. Yeah.
Yeah. I'm excited to get to your segment, Aaron.
I'll have a slide of Kramer in my segments.
I'm excited for that.
We're all excited. All right. Well, let's get through this. Let's get to the, I'm going to share my screen right here quickly. All right. So this is an excerpt here from a presentation I gave recently. The slides here are really showing some of Keystone's great capital compounding recommendations over time. The point of this section was to show investors the powerful effect of adding just one or two truly great stocks can have on your portfolio. And I said it's a very simple but powerful concept, but not one you'll hear from most advisors. Essentially, investing your 2 or 3 truly great stocks in your lifetime can be game-changing in your portfolio. But don't just take my word for it. In fact, the past year, Warren Buffett, perhaps the greatest investor of all time, stated that in his 58 years of Berkshire management, his satisfactory, and we all know they're well above satisfactory results, have been the product of about a dozen truly great decisions. That would be about one every 5 years. So let that sink in. What he is saying is that only 12 great investments or stocks in his almost 100 years on this earth made him one of the richest humans on the planet. It does not take many, and perhaps most importantly, they do not have to be complicated moonshot businesses that promise to change the world. Often they are most boring or mundane businesses you can imagine. One of Buffett's greatest wins came from Coca-Cola. They are a seller of soda pop. Others include Bank of America, a banking business, American Express, all businesses we can understand, all returning massive capital compounding returns, and are all a reminder of this, that boring businesses can produce astonishing returns with less risk. Now, I like to give real world examples from our research, and these are the types of boring businesses from our research that you can look at today. 4 of Keystone's recommendations that have literally changed the fortunes of our clients' portfolios. I put these numbers up here because they kind of make us look smart. Quite frankly, the other 3 guys need it here, but me, not so much. So I do it for them. My real point is here to show that boring businesses can produce astonishing returns. What does Boyd do? They own automobile repair shops. They fix cars. Hammond Power makes electrical transformers. It's been in business for over 100 years. Expel, they sell automobile paint protection film. Water Furnace makes geothermal heating and cooling systems for homes. Not sexy, but look at those returns, and that's what you're looking for. Having heard this, I say a couple of questions should pop into your mind. How can I find the next Expel? And we get this question all the time. Boyd, Hammond Power, or Water Furnace, or what do these great businesses have in common? Now, as far as the profile of a stock you should be looking for, we have literally created 3-hour webinars on this topic. We don't have time to go into that today, but I want to keep it simple. You're looking for great cash flowing businesses with good management teams that trade at reasonable prices and have a long-term growth path ahead of them. Now, number 2 question should be, how do you construct a portfolio to capitalize on the great capital compounding stocks like these? Well, first, as we say, do not build it with the traditional big bank portfolio model, where you essentially, your advisor complicates your portfolio with 5 to 25 plus ETFs, funds, or other investment vehicles, each of those owning 50 to 200 plus stocks, leading to a portfolio that holds 500 to 1,000 stocks, which is essentially owning the market. If you construct a portfolio in this manner, even if one of these great stocks makes it into your portfolio, it will be one of 500 or 1,000 plus individual stocks, which will not move the needle in terms of returns for your portfolio. What we advise to do is very simple. Build your own stock portfolio. Take control. If you want to beat the market, you cannot just be the market owning 5 to 25 plus ETFs or mutual funds. Now, what you can do is create your own simple equity portfolio. It's a strategy that we've coined focused diversification. What you're doing is building 15 to 25 stocks in a portfolio gradually over a period of 12 to 24 months. What this does is reduces risk or exposure to short-term market corrections, and it provides flexibility to add to new positions as new opportunities or new research becomes available. What is the process here? Well, if you're going to use our research service or you wanted to go it alone today, start the process. You can start with 3 to 5 initial positions or stocks to add to your portfolio. You can add 2 to 3 new stocks per quarter as new information or research is released. You can also layer into those positions. You don't have to buy a full position. Say you had $100,000. Let's just use round numbers, and we're going to buy 10 stocks. Take 100, divide it by 10. It's 10,000 in each. You might buy a half position, which would be 50% of that, or $5,000 to start, and add to that over time. So let's look in practice, an example of what the structure of a portfolio built with a focused diversification strategy would look like. Here, we can see our 3 core areas of research. You're going to have 7 to 10 stocks deployed into these 3 core areas. The core areas: Canadian small cap, growth stocks, those lesser known companies, good profitable businesses, core Canadian dividend growth stocks, and core US growth stocks, 7 to 10 in each area. I put together a simple example also. It's an allocation example here. If we see, if you had a $500,000 portfolio, nice round number, 20 stocks in each with an equal weighting. What I mean by that is if you have $500,000 to deploy, divide that by 20 individual stocks, you're equally weighting them at 25,000 in each. Now, what my goal here is to show you is how impactful one great stock can become on a $500,000 portfolio. As you can see here, this is the $500,000 portfolio. 15 years ago, for example, Boyd was included on an equally weighted basis as one of our top recommendations at that time. Today, if you would have bought them with that $25,000 position as one of those 20 stocks, Boyd itself would be worth in the range of $3.3 million. Just one stock is worth nearly 7 times the entire original portfolio. Literally all other 19 stocks in that portfolio could have gone to zero, and this portfolio would still be in solid shape. Of course, we are not looking to have all 19 other stocks go to zero. We're looking for growth in those businesses as well. But it shows you the truly amazing power a great stock can have on your portfolio if combined with the right research with a portfolio built in this model. Now, if you had $1 million in that portfolio, it would be worth $6.6 million today, that one position in Boyd. And the returns are even better if we use Hammond Power in this example. That is now outperforming Boyd. So I think there, my point is made, and we can move on to comments from our other gentlemen on this podcast. They got nothing.
No, I got something because I need to make myself look smart. After you were sending shade our way. I had one conversation with...
That's all you remember from that entire presentation is that little bit of shade, right?
So I had one conversation with a lady at the booth, and, I said kind of what you were saying, where, we're looking for, like our value proposition is we're going through every single stock in Canada. We're going through thousands in the US to find, the Boyd or the Hammond. And I said that to her where, all of the other stocks in your portfolio could literally go to zero, like you said there, Ryan, the 19 could go to zero. And she gave me a crazy look like, what do you mean? And, we're using that as an example. Again, like Ryan said, it's an extreme example. Again, the businesses that we're looking at and recommending, they're cash flow producing. They're not cash burning, good balance sheets. These companies, aren't going to go to zero. I have been with Keystone for, 5 years now, and I have not seen any of our stocks go to zero, so just making sure that is clear for people who heard that.
Yeah. And like we said, those 20 stocks, the other 19, not all of them are going to be successful. And even if you've done all the research in the world, if we've done all the research in the world, you're going to have some losers in that area. But if you have, a few great stocks in there, it allows you to make mistakes, but you also can get good gains in that other part of your portfolio. And then you can really achieve the wealth that a lot of people are really looking for. If you just want to mirror the market, there's better ways to do it than most people are doing it out there too. Just buying simple, low cost, 3 ETFs to cover, one to cover Canadian, one US, and one international. Many people are being charged like a 2% administration fee to do that. You don't need to do that. You don't need our services or help to do that. People come to us because they're looking to beat the market and they're dissatisfied with their returns in, their general big bank type design portfolio. And, that we're trying to have them have a fighting chance to structure their portfolio properly to be able to take advantage of good gains in companies and not just be the market. That's why, again, we're not buying 2 or 3 stocks. We're not buying hundreds of stocks. It's a sweet spot in 15 to 25, depending on the size of your portfolio.
Yeah, one thing that I'd also like to add, just, that Aaron made in his speech at the World Outlook, which I think is like an important, and it was really good, where, he was complimenting Ryan and saying that, Ryan's, small cap discovery research has been very top tier, not only because he's found, the Hammonds or the Boyds or whatever, there's many other names that, like International Road Dynamics, H2O Innovation, which just recently got taken out.
Photon
What's
control.
Photon Control. Again, like these are, thank you, Ryan.
It's okay.
Like these are companies that, 200, 300, 400% returns as well. So again, obviously we're looking for those, 1,000% returns on stocks, but, again, we're finding other businesses that are obviously, having value over the long term.
Well, everything
Yeah, and the
you say is
thousands of
true,
print aren't the
Brandon, but
most
I don't
realistic.
appreciate being reminded that I actually complimented Rob.
It's true.
Yeah. I don't blame you.
Moving on
People,
from that.
I'll just say people ask a lot about how we can find the next Boyd or the next XPEL or the next Hammond. And you don't necessarily know when you're recommending a company where it's going to end up. But the point is you're basing it on the model. So the model of all these companies is the same. And that's that they're profitable businesses that are growing and that have some type of a growth strategy or are serving a market where that growth should be sustainable over time. So then that compounds. In the case of Boyd and Hammond and XPEL, when they were originally recommended, they were largely unknown and underfollowed, right? So that's another thing. So finding a great business, the great product in a strong market that is being ignored. And that doesn't happen every time. That doesn't happen every recommendation. But in order to find the next Hammond, you stick with that model, really. And as long as you stick with that model, even though a Hammond doesn't come, every month or even every year, you eventually get exposed to the Hammonds.
Yeah, and you have the potential if you structure your portfolio that way. That's
and the
what
ones that don't become Hammonds, more often than not, still go on to perform very well.
Okay, well, we're gonna move on to Aaron. He's gonna take a look at the big jump in Meta platforms or Facebook last week as they implemented a dividend and they had their quarterly results as well.
Excellent. So we're going to talk about Meta Platforms, symbol META on the NASDAQ. Company is a $1.17 trillion company, so part of the magnificent or mega cap 7. It's trading at a price of just under $4.60 per share, and it just started paying a dividend, which equates right now to a modest yield of 0.2%. So Meta, which is of course formerly known as Facebook, is a leading social media and technology company. Most people know it for its main platform, which is Facebook, but it also includes other social media platforms like Messenger, Instagram, and WhatsApp. They recently also ventured into the augmented or virtual reality space, which is done through their subsidiary Reality Labs. So the company had big news. It's been in the news quite a bit over the last few days. They put out their Q4 results on February 1st and initiated a quarterly dividend. The stock jumped about 20%. That's a $197 billion gain in one day, which breaks the record for the biggest market cap gain of any stock in history. Now, we do have to be fair here and mention that Facebook or Meta also holds the record for the biggest market cap loss in history as well, which happened in February of last year. And it was a $232 billion decline in the market cap. Quite massive and so big that it actually made Jim Cramer, cry on live TV, which he got criticized for. We made fun of him for that as well because he had been recommending Meta at the time. He was quite positive on the company. They came out with a bad quarter, and it made him cry. And he said that he was wrong. He made a mistake. He trusted the management team, and that was ill-advised. Now, somewhat coincidentally, I guess, shortly after he said that, the stock started to go up, and it's been one of the top performers from last year. So he probably should have just stuck with his original thesis. But anyways, that's neither here or there. We're going to take a look at these Q4 results and just break them apart a little bit and see what's been going on. So revenue growth, very strong, 25% to $41 billion for the quarter. But income from operations up 156% to $16.4 billion. And then the operating margin more than doubling to 41% from 20% in the same quarter last year. And earnings per share of $5.33, which is 203% increase. So great results, certainly on the surface, what we're seeing here is strong revenue growth, but also a decline in expenses as well, which is really what has driven a lot of the operating income growth and earnings per share growth. Looking at some of the operational highlights, some of the metrics that the company uses: family daily active people. When they say family, they mean their family of social media products. So that includes Facebook, Instagram, and the others as well. But 3.19 billion on average for December, which was an 8% increase year over year. Monthly active people was 3.98 billion, an increase of 6%. And when we look at ad impressions, and we have to keep in mind that Facebook is very much an ad company. I think about 95% of their revenues come from ads. So ad impressions and price per ad, very important metrics. Well, in Q4, ad impressions increased by 21% year over year. Average price per ad increased by 2%. Now, for the full year, impressions increased 28%, while the average price per ad declined by 9%. But obviously, they made that price decline up through volume. And then another very key factor here was headcount. So ended the year at just over 67,000 employees, but that's a decrease of 22% year over year. So we've heard a lot about these big tech companies laying off workers, laying off a lot of their technology staff. And that was also undoubtedly a major factor in the higher margins and the lower expenses. So really, there's a few things in play here in terms of why people were so optimistic about Meta. So one was obviously just the fantastic results, but we also have to keep in mind that's not all revenue growth. That's a lot of operational efficiencies, which do have a limit at some point, one would think, at least operating efficiency gains of that magnitude. But another is really that Meta is really came out as focusing on AI. Now, this isn't this isn't news to people that have been following Meta. Meta's been very active within the AI space, launching some of the top open source large language models, competing with OpenAI's model GPT. But they really came out with a focus on artificial intelligence and started to identify some specific opportunities. Now, of course, there's the metaverse as well, which is the augmented reality, the virtual reality. They're still focused on that. It's not generating much in terms of revenue. I think about 1.5% of revenue right now, but it's losing money. So really, they're indicating AI as being a major growth opportunity. One of the goals here is to develop the most popular and advanced AI products and services. So they're talking about AI assistance, AI for creators and businesses, and state-of-the-art open source models for developers, which they've done. So they believe that this is going to produce a wide range of potential revenue streams. They want to continue to invest aggressively in their compute infrastructure for AI. So this is all of the cloud computing infrastructure that essentially runs the models. This is also a competitive advantage as well. And then just research into general artificial intelligence. So this is essentially AI that can do anything that a human can. That's not where AI is right now. That's the long-term objective of everybody, essentially, who's at the top tier of the space, like OpenAI and Meta and Alphabet as well. But they're very focused here. And one of the things that they believe is a competitive advantage is that they want to strategically utilize the data that they get from their social media platforms like Instagram, Facebook, and Messenger in order to train these AI systems. So I would agree that is a competitive advantage that Facebook has. It's a very competitive space right now. I mean, you have Microsoft, you have Alphabet, you have Meta. These are really the three top companies, I think, in the space. But they're all looking to come out with the top assistants and the top tools for creators and businesses. So it's a very competitive space. But one of the things I spoke about at my speech at the World Outlook Conference was that investors should stick to companies that have established competitive advantages. And I think that we could look at Meta as having some pretty strong competitive advantages. So looking forward for growth, analysts are quite optimistic on where the company's going right now. So midpoint of consensus estimates for the current year is 1937. That would be about 30% earnings growth over last year. And then analysts are looking at about 17% growth to 2257 at the midpoint for next year. So this puts Meta at about 24 times current year's expected earnings, 20 times next year's expected earnings. So really it's what I would consider to be a reasonable valuation on Meta's stock, and fundamentals across the board are pretty pretty spectacular, pretty strong for Meta. I mean, it has a net cash balance sheet, I think about 65 million in cash, about maybe 18 million in debt. So it as I said, it has those strong competitive advantages. It's targeting a space where presumably there's going to be a lot of growth, albeit a lot of competition right now. So one of the things that I've always said about Meta in the past, that's been a little bit of a complaint from an investment perspective, is that they are so leveraged to Facebook. I mean, Facebook, Instagram, they're two main social media platforms, but mostly Facebook. And I don't know any younger people, like say in my family, for example, that have any interest in Facebook, right? Like the youngest generation is on TikTok primarily and Snapchat. Most millennials choose Instagram over Facebook, which is still a better property, but social media can be such a fickle space. So you just never know how those trends progress over time. But it is looking like the company is focused on diversifying its revenue streams and targeting AI for that. So I think the fundamentals are very strong. In terms of where we go next with the company, that would really just depend. As I'd said, Meta is a member of the Mega Cap 7 technology stocks in the US. We already have a couple recommendations, companies that we prefer just on a growth risk perspective that we think are better diversified businesses, and also have growth and great fundamentals across the board. But I like what I'm seeing with Meta right now.
Yeah. Number one, I just think, like Kramer coming on TV, I think it was like October of 2022. The stock literally hit like, its low. And then, he went on TV, cried, said, "I failed you guys." And we only saw the stock go, up
It's pretty
since
much
then.
right after that. Yeah.
Yeah, it was literally right after
Now,
that.
again, there's that reverse Kramer fund, right?
Yeah.
So I don't know. We should check that.
It must be killing it, right?
Yeah.
I mean, and I don't know if he was actually, saying, I'm out, I'm selling. Because I think I was looking at an article of him talking about, buying it again in October of 2023. So, he might have been on the buy when it was higher again and it rebounded. I don't know. But either way, it's quite interesting.
Well, he was
One
quite
thing that,
emotional about the decline.
yeah, definitely. And like, that's the thing.
A lot
Like,
of people felt it wasn't worth crying over, even if you made a mistake.
yeah, exactly.
You're growing
Exactly.
You think? I mean, doesn't he make 400 recommendations a show? Like,
I think he was quite vocal about Meta was the thing as it was going
Yeah.
down. And
I mean, I haven't honestly watched the show in years, but I just used to watch him hammer a buy button and, it's basically like,
then he's
like,
yelling.
I mean, he's pretty vocal about every recommendation. This is awful. This is the greatest thing ever.
Yeah.
It's financial infotainment or something. I don't know what it was.
Yeah, exactly. One thing that I'll also say about Meta is I ended up watching an interview with Lex Friedman, who is a professor at MIT, I believe, as well as Mark Zuckerberg. So Mark Zuckerberg came on Lex's podcast, and they ended up doing a podcast in the metaverse. So essentially, Lex ended up getting his whole face scanned and his body scanned, and so did Zuckerberg. They had to go to an actual facility and do this.
And they found out he was a robot.
No, they didn't find out that he was
okay.
a robot, but it is interesting. Like, I'm sure that there's, like Aaron was saying, lots of competition with this, or other companies trying to do the same thing. But, the detail, even, if you go and look or watch the video on YouTube, I think it was posted like September of 2023 when they did this podcast, and just the detail. And even when Lex is in there with, the virtual reality goggles on, looking at Mark, he's just saying like, wow, I can see every single crease in your forehead. Like, it's just so real. I feel like, this is basically
Nobody
in person.
wants to see that.
No.
you could just erase them if you.
Yeah, that's
true. Good.
Yeah. Now I'm going to sip some water like Mark Zuckerberg.
That's a nice mug.
Yeah.
All right, are we moving on?
I think we're moving on.
We're going to Reliq.
We are
Reliq from the Beachcombers.
Oh yeah, I forgot.
No one knows what I'm talking about when I say.
I do know what you're
Reliq Health Technology, symbol RHT on the TSX Venture. Brennan is going to reprise his segment on this. He's going to look at this company from at least the second, maybe third time
I think
at
it's the
least. Now, I think.
third.
Yeah.
Yeah, it's my
We
third
keep getting
time.
questions.
Yes, you guys ended up
People are very
analyzing it
passionate
in
about this company.
2019 before I was with you guys. So yeah, this question came in from Anna via email on Reliq Health Technologies Inc., RHT, on the TSX Venture. It's currently trading at a price of, well, it's halted right now at about 21 cents or 22 cents, has a market cap of 41 million, and the company is a telemedicine provider that provides virtual care solutions for the healthcare market, and it offers its iUgo care platform, a software as a solution that allows patients to receive care in home. So, to remind listeners, yeah, we have reviewed Reliq a few times on the podcast. Once in 2018 as a dog when the stock was down 85% over the course of that year because the company was, putting up severe losses on some of the contracts that it had recently secured. There was optimism around those contracts. They didn't really turn into profits. And keeping in mind at that time, the business was completely contract driven. Then in September of 2022 and again in August of 2023, we reviewed the stock as a Your Stock Our Take segment, considering the company had switched from primarily a hardware business to a software as a service model in 2021, and it was showing good revenue growth but no profitability. And since I covered the stock last in August of 2022, the stock is down, or 2023, sorry, the stock is down 55%. So what is driving the stock lower? Well, number one, Reliq's last quarterly financial results were reported back in May of 2023, which was for Q3 ended March 31st of 2023. And these were the financials that I reviewed on the podcast over 6 months ago. And I did say at that time, revenue was showing good trajectory and they were just breaking into profit, which was good to see at least. However, though, the company ended up announcing on October 31st that it was unable to file its audited annual financial statements and expected to file them on November 14th. The November deadline went by without any results, and the company then announced that it expects to file its annual filings on or before January 12th of 2024. But this date also passed. So currently outstanding are both the annual financial results, which are for the period ended June 30th of 2023, as well as Q1 of 2024, which was for the period ended September 30th, 2023. And as a result of the missed deadlines, the Canadian Investment Regulatory Organization placed a temporary trade suspension on the stock, which is still in place right now. Now, number two on what is driving the stock lower, just further dilution. Management stated in 2023 that they expect strong growth in 2024 and that it did not expect to need to raise capital or take on debt to fund operations. However, as I predicted would likely take place given the negative cash flow, on October 5th, the company raised about $6 million for 15 million shares, which now places the company's outstanding share count at above 220 million shares outstanding. And I'm just going to leave this YouTube comment up on the screen here from Josh Jordan, as it aged quite well, or at least for me, in relation to my prediction that the business will have to continue to dilute to keep the lights on. And he says they will not need to dilute more shares to keep the lights on. They will not need to do that. They have more cash on hand and will most likely buy shares back in 2023. Well, that didn't happen. So going to the other reason why the stock was down. So while all this has been going on, there's been a bit of a shuffling with management as the CEO, Dr. Lisa Crossley, resigned for health reasons. And then they brought in a new CEO or interim CEO, Chris Shields. So overall, uncertainty is definitely heightened at this point and is essentially why we have seen the stock lower by over 50% in the past 6 months. But as I said in August, I think that it will be crucial to ensure the business can maintain its slight profitability achieved in Q3 of 2023, which was, reported almost a full year ago now. But clearly, investors of Reliq remain in the dark, and we have no idea if the company will continue on its path of, profitability going forward here. So yeah, that's Reliq. Not a great story for shareholders at this time. And again, I need to make clear, this is not a recommendation. I've been steering clear, or I've been telling clients to steer clear, or not even clients, listeners, to steer clear from this stock, just because, again, we've seen good revenue growth, but we need to see that actually translate into profitability. They've announced so many of these large contracts, but again, until the company can make consistent profits, we just aren't sure about the business model.
Yeah, it's a good summary. I mean, our basic criteria is cash flow, profitability, and, there's some revenue growth, but we haven't seen the cash flow that we need to see on a per share basis grow to drive the share price higher. And, there's also some other issues obviously going on here with the business not filing.
Yeah.
It's hard to comment on what exactly is going on there. But it's, the overall numbers don't meet our criteria. And then, when somebody asks about it, that's all we can comment, that it just doesn't meet our criteria, which includes profitability, because what we're trying to do is protect against some of the downside we've seen in this company from where it was at its highs, when you don't have that underlying cash flow supporting the share price. All right. Do we have any other comments on Reliq, or I think we basically beat that one?
Yeah, I think it's good.
Horse, right? Yeah. Okay. Brett, you're going to talk about Linamar, which is a company in a significantly different position. They are an advanced manufacturing company for automotive and manufacturing usage. But some acquisitions and some good growth in the business, and relatively look like reasonable valuations.
Yeah, no, I'll get into it. Like Ryan said, going through Linamar, we got the question from Greg via email as well. If you want one of our lovely mugs, yeah, you should send your questions in, and if you get chosen, we'll send you out a mug as well. I think we have another nice box worth of them after the conference. But getting into Linamar,
they were very popular.
They were. We had quite a few people come up and ask for them. So
yeah, bag.
Yeah, bag. Send in your questions if you want a mug, and we'll probably end up getting more down the line. But get them all you can.
They were just begging you guys. They were threatening me. They were like,
"Wow." They take it to a whole new level with you, right? It's true.
Just kidding.
They know the weakest link.
Pleases, yeah.
Okay, but Linamar, like I said, got a question from Greg. But Linamar is an advanced manufacturing company for automotive and industrial usage. The company is broken down into two segments: industrial, which includes equipment like scissor lifts, as well as farming equipment for all parts of the crop production cycle, once they have acquired their latest acquisition, Borgalt. On the mobility side, products include vehicle chassis, engines, transmissions, and components for electrification. The stock is currently trading about $65, or a $4 billion market cap, with a yield of 1.4%. The stock is trading down 11% over the past year. Looking at the last quarter, Q3 2023, revenue was up 16% to $2.43 billion. Gross profit increased 22.5% to $340 million, which is at a 14% margin, an improvement over the prior year's 13.2%. Moving down the income statement, operating earnings grew at 15.6% to $214 million, a flat margin of 8.8% compared to the prior year. EPS grew at 13.3% to $2.38, a net margin of 6%. For 9 months, EPS grew 25.1% to $6.47 at a margin of 5.5%. Further, removing the impact of foreign exchange or FX and certain gains and losses on non-operating activities, normalized EPS for the 9 months increased actually 45.9% to $6.80 from $4.66. The normalization is really just an attempt at them isolating what their actual operations. So you'll see that quite commonly. They'll remove foreign exchange, one-time gains or losses. It's really just to see how the company's actually doing within management's ability year over year, but it doesn't replace GAAP EPS. But shifting to the balance sheet, the company has cash on hand of $695 million, with debt of $1.7 billion, resulting in a net debt position of $1 billion and leverage of 0.8 times off adjusted EBITDA. However, after the quarter's end and closing now in Q1 2024, just last week from the time of recording, they finalized their acquisition of Borgalt for $640 million, increasing leverage to 1.4 times. The acquisition is the continuation of its diversification strategy into farming equipment. The company is now able to offer equipment for the full broad acre crop production cycle. Reliq is expected to add sales in the range of 450 to 500 million, with its operating margin in range similar to the industrial segment that they currently have of 14 to 18%. The company expects roughly 55% of its operation earnings now to come from the industrial segment, and the remaining to come from mobile. Remaining 45% come from mobile after this acquisition, which previously 5 or 6 years ago, it was dominantly mobile. So the diversification into industrial is significant now at this point. Quickly jumping to a slide from their corporate presentation showing the historic leverage, Linamar has been able to lower leverage after acquisitions before, deleveraging as the company acquired companies and assets, or re-leveraging, I should say, as the company has acquired companies over the past 2 years. You can see they were effectively net zero leverage. And then as they bought GF Casting, then Salford, then assets from Dura and Mobex and Shiloh, that they increased their leverage over that time. And they're still lower than what they were before that big deleveraging in 2020, but it has crept back up to that mid-single digits range. The company does further expect to be able to deleverage to about that 1 times in the next 12 months. That's something which we'll be watching, as leverage in these low margin manufacturing businesses, if it does start to get into that 2.5, 3 times range, that's where it can get quite iffy. If they cannot pay that down, obviously they're not there that high yet, but it can quickly go awry if you stay at that higher leverage for a long period of time, because it eats away at the already low margins. Further, if we take a step back, looking at the historic trends on a 10-year timeline, the company has been unable to be consistently accretive on per share growth and has seen rather stagnant since 2018. But that's really when they start to do their acquisitions, as well as they saw the cyclical nature. We saw a slowdown in the automotive industry, and as well as industrial in the 2020-2021 year, which of course, as well, acquisitions, they normally create a short to medium term drag on earnings, as well as the goal is normally to create long term growth, which is their goal here. So moving to valuations, the company is trading at 8 times PE and an EV to EBITDA of 4 times. So the market at this time is really pricing in no real growth, because they have that 1.4% yield on it as well, which implies the company's effectively expecting no growth, or the market's expecting no growth for the company. Concluding, the company is becoming interesting as it is quite cheap, and they have been on an acquisition spree over the last couple of years. The balance sheet post-acquisitions still has room. It isn't at the point of being over-leveraged, but it is something you do want to watch, because if they were to go, let's say, do another 1 or 2 acquisitions the same size of Reliq, that would put them at the upper end or over where we would like to see them. As of now, we would like to see growth from the integration of the acquisitions, as well as, of course, organic growth from their existing business lines. And we would need to see that hit the bottom line, not just sales growth. We need to see it per share, on a per share basis of earnings, not just sales or not just EBITDA. We need to see that in earnings. As well, with the latest acquisition, we should be able to see a bit less cyclicality, which is always nice to see, as farming is less cyclical than the automotive industry. And yeah, as a whole, we'll just continue to monitor the company for that per share growth. So the one thing which you'll really want to watch for if you do start to see the growth is if the market is willing to give them a bit of a higher multiple. If they can get that to that 10 times 12 multiple for price to earnings, then you can really see some nice returns on a company like this. But to do that, they need to see some sort of accretive per share growth.
I agree. Diversification outside of what is historically a cyclical end market, the automobile segment, would potentially afford a higher multiple at some point, because that sector, automotive parts, essentially has traded at a discount for decades because of the inherent cyclicality. Although, again, the estimates right now are for Linamar to grow again this year and grow on a per share basis. So it does look cheap relatively on a historical basis, and to the market, of course. Again, auto parts manufacturers typically trade at a significant discount, but it looks quite significant now, given the fact that there is some growth as well, and there has been for a couple of years. So yeah, it is an interesting company. The dividend's not huge, but it has grown. Has it not grown over time?
It's inconsistent growth. So like
Okay,
08, they cut 2022, they cut, then they brought it back up, then it was flat for a few years. So you're not going to see that year over year growth. You see a jump up for a few years, then flat, then jump up.
Consistent with the inconsistency of the market.
Exactly.
Of the inconsistency of its end market, right? Yeah, exactly. Okay.
Yeah. So
Makes sense.
Yeah, I put them as cautious optimism at this time.
Yeah, for sure. All right, Brennan, you got any final thoughts? Or are we good?
I like that one slide that you brought up just from their investor presentation showing like the deleveraging over time. I think that is, great that a company is, posting that and showing that, and, we'll monitor it going forward and see if they will delever again a little here. That's it. That's all.
Excellent.
Great
Okay.
comment.
Well, let's close out. Yeah, it was great.
Okay.
Let's close out the show this week. We're glad to have all our listeners. It looks like more and more listeners over time. Keep your questions coming in for our Your Stock, Our Take segments. We've got these mugs now. Everybody's wanting to get their hands on them. Send them out. Then we'll probably announce a winner of a mug potentially next week. Yep. Again, questions coming in. Rate and review us. If you're looking at this right now on YouTube, you can smash that subscribe button. If you're listening to this on iTunes or wherever you consume your podcast, rate and review us. Only positive reviews. That's what we like. And again, I like to wish everybody out there profitable investing. Thank you.
Thanks, everyone.
Thank you.